All right, quick video today just to explain how to read the volatility cone. I had the question in the group yesterday. That chart is not the easiest to read. I give you guys that. It used to be extremely popular 10-15 years ago. Today I still use it, but definitely not to find places really where there is edge. I will be looking into the VRP table and probabilities to drive a decision rather than looking into this chart. So basically the idea of the volatility cone is to foremost represent what realized volatility has been in a not so distant past, and then compare it to where implied volatility is right now. So to see where realized volatility has been, you have to look into all the different lines that define that cone, right? So you have, if we read the tooltip here, you have 5 lines. You have max, mean, percentile 20, the median, percentile 50, and then percentile 80. So what that means is for this specific period, let's take something like 30. So it means that over a not so distant past, so usually I do these things over a 1 year period, the maximum realized volatility measure across 30 days has been 36.56. The minimum has been 17.18. And then when you do the distribution of all those realized volatility, you realize that bottom 20th percentile is 20%, top 80th percentile is 26.6, 26.7, and then the median is at 21.7. So that really helps you to get the context of realized volatility for that specific period you're looking at. So if you want to come closer and look into something that's going to be much more weekly volatility, then obviously your number changes, right? The maximum we have observed is 63 almost. The minimum was 12, and that kind of makes sense. The closer you get to very short time frame and the more wild swings you can have. So that was around here. So that's period 30, right? So period 30, we were saying above that the highest we've seen was roughly at 36, and that's indeed what you end up seeing here. If you were to switch your period to 7 instead of 30, then yeah, we can find that peak right in the middle of the tariff in April and see something that looks like the number we were seeing above right here, exactly 62, 64. So ultimately, those lines here, and in the case of EWZ, they're quite compressed, right? But if you take something different, something that has much more volatility, that moves much more, like TSLA, for instance, you'll see that your lines have much more space between those, right? Like across the last year, if you look at 21 days and you remember a period where TSLA was extremely quiet, realized volatility was at 30 at the minimum. Right now, actually, if you measure it at 21 days, you will see that it's at 33.6. And this is represented by that blue bar here. The blue bar here is going to give you where the current level of realized volatility is right now. And then next to it in green, you'll see what we think the forecast is going to be. So basically, those two bars here are nothing else than the bars that you see here for the forecast. So 21 days in TSLA. Right now, the forecast is roughly at 34.83 and then realize 33.6. And that's what we're plotting here in this chart. So that helps you to see in the entire context of where we are right now, that entire cone between the maximum at the top and then the minimum at the bottom. Right now, one can clearly see that realized volatility in TSLA isn't particularly intense, right? It doesn't mean the stock won't move. It just means that in the context of TSLA right now, things are pretty quiet. It also doesn't mean necessarily that it's going to revert right to the medium figure just the next second or the next week or whatever, right? Volatility tends to cluster. So it's just help you to get context and put things into perspective. So we know what the different lines are. We know what the two bars here are. So again, the two bars now we know are vol, that's the blue one, green forecast, and then you have all of those different lines that describe the context of realized volatility over the last year. Now, what exactly are those two dots where we see VAR swap bid and then VAR swap ask, right? That is essentially the measure of implied volatility in the option contract in Tesla. So right now you have an option contract expiring in 43 days. You align it with realized volatility over the last 43 days, and you build a lot of context around that stuff. You have a lot of statistics, max, min, and we don't compute the forecast at 43 days. Doesn't really make any sense. But once you're here, you can use that forecast here at 30 days and then compare it where the market is currently trading, and that's given by the VAR swap bid and then the VAR swap ask. Then in a contract like Tesla, stuff are extremely liquid, so overall you don't see a big difference between the bid and ask from a volatility perspective. I insist on this. Basically, just take all the option out of the money option prices. I do some arithmetic around it. The formula is actually on the internet if you guys are curious. And then you can extract the implied volatility from the option prices. It's a model-free volatility estimation, which I like quite a bit. And then you can plot those prices in the overall context of realized volatility. So here, what's interesting is that 30 days right now, the market is basically, again, not being stupid, right? The market is basically pricing implied volatility at the median of realized volatility over the past year. Does it make sense? Does it not make sense? Everyone can decide, but this is where the market is pricing. And more often than not, in a structure like Tesla, you will see that when things are pretty calm, the market tends to follow those statistics with some variation based on some names. But here it's a really great example to see that, like, okay, realize is extremely low. The market isn't going to price at the maximum we've seen. It's going to quietly sit at roughly the median, 50th percentile. Now, once you're here, you can clearly see the variance risk premium and where your margin is going to come from, right? In the case of Tesla, if you were selling here at around roughly 53, something like this, considering that these days we do realize something like 34 and we forecast realize 35, 36, if you sell and delta hedge your options, you're going to make a decent bit of money. And even if you had tomorrow a big change of regime and our forecasts were completely wrong, well, you would need a massive spike for realize to like eat all of the margin that you've just sold, and you're going to be able to get away with it. So that's in and of itself probably not a bad trade to consider in Tesla. Now, we did start not with Tesla, but with the Brazilian ETF, EWZ, where you have that massive ask here and the bid here. So what exactly is happening? I do capture option prices at 345 before the close, and all you see here is basically market makers starting to pull off their orders. The books start to be much more sparse, and ultimately, if you look at the quote at exactly 45, well, you will see a massive bid-ask spread, where if you just look at the market for what it is, the bid is going to be at 2068 and then the ask at 69 something. That's obviously wrong. Trying to get a mid price as well is unrealistic. That's ultimately the reason why you might see some tickers completely out there. There's a few ways for us to try to improve this over time. The main limitation right now is that I just take snapshots of data every 5 minutes. I don't have continuous pricing between a candle of 5 minutes. But that's about it, right? That's how you read that code. Don't get too discouraged sometimes when you see those readings that goes a little bit all over the place. Ultimately, what really matters is when you take one of those names is to always compare, okay, where is the market right now? So it's going to be the two bars. Where do we forecast the market to be over the next 30 days, for instance? And what is the market currently giving? So it's interesting because in the case of NVDA, right now implied is almost low, right? It's sitting at the 20th percentile of where realized volatility has been over the last year or so. If I had to pick, I would probably be short vol more on Tesla these days than in NVIDIA. And if you really wanted to like do some interesting stuff, you could potentially think of doing a short vol in Tesla, for instance, and then long vol in NVDA. We have the long short module in the platform. You can look to this. That's just an idea. Once again, doesn't mean you should go do that tomorrow. Just check the math, the statistics, and everything. That's it really for the volatility code. If you guys have questions, leave them in the comments. Come in the Substack. I'm always happy to answer. And then, as usual, happy trading.